So again, I'm Jonathan with IVolLive. Our agenda today is to cover the different calculators available to you within IVolLive. If you're new or just joined us, IVolLive is like a very powerful analytical and data tool to power your options trading, right? So I use this as an options trader for 10 plus years. I use IVolLive to give me my data, my charts, my tool, my analysis. And then I take that, decide on my trade, and enter that trade with my online broker. So I use IVolLive as my kind of analytical brain to evaluate the trades and the strike price, and the actual underlying price I should go for when I put on actual trades. So that's how to think of IVolLive, a great tool, analytical tool for your trading. So here we are. We also recently announced our API product. That's really, really helpful for back testing purposes. So if you have strategies that you want to back test, see how they would have panned out, this API product is excellent. We'll do a video recap and send that out via email. And in that, I'll have the team put a link for the API release. And that way, anybody that's not familiar with that could check that out. But it's a really, really, really good back testing tool. It kind of goes hand in hand with our data download here in IVolLive. So just kind of a brief aside there. So here we go. When you join IVolLive, if this is your first time, you'll go to your dashboard. This is kind of like your homing beacon for the platform itself. Excuse me one second. We have a couple more people in the waiting room. Let me admit. There we go. These Tuesday sessions do tend to get busy, so you'll hear me just kind of pause briefly as I let people in as they come in throughout the hour here. So again, our overall goal is to go for about 30-40 minutes on the calculators, take any questions that pop up, and then if you forget your question, you can always shoot us a note and we can get to it via email. But within IVolLive, here we go. You have your friendly concierge who will welcome you to the platform. You also have this glowing join button here. What this means is this is probably how, most of you, found the link, whether through email or through your dashboard. This is where you would go to sign up for upcoming webinars. Each week we have a different topic. Today's calculators. Next Tuesday will be something else. But the way you always register for those is here. We do recommend doing that in advance because they do fill up. And, here we go with our friendly concierge. He's going to point out different little shortcuts to access our tools. We're going to spend most of our time in the IVolLive button and in the P&L calculator section. Those are where their calculators live for today's, webinar. So we'll spend most of our time in there. Here it is. There's IVolLive. Here's a little toolbar. Depending on what you prefer, you can expand or contract the views there. And then we have our, of course, support at iVolatility. We're available for you anytime, anywhere, for any questions you may have about iVolatility or IVolLive. So please do not be shy to reach out to us there. Here we go. Within your dashboard, ultimately, I just did 3 successive weeks back to back to back on charts. So we did charts part 1, charts part 2, charts part 3. And kind of the point that I made in those webinars is charts are only valuable if you know what you want to analyze. Calculators are pretty similar. You need to have inputs to run through a calculator. So what I do here is, within this section, latest news, as I always say, I always get 1 or 2 pretty good ideas, just kind of skimming through the latest news. Maybe it's IBM, maybe it's Meta. They always give me at least something to kind of chew on. And then we have our news and research section. And our news and research section is interesting because this is what we put out from our editorial team. And the reason why that's interesting is because we're using IVolLive to find these ideas. So in our typical newsletter, these go out on Thursdays. You can see this last one was August 17th. We kind of recap what's going on in the markets. We look at different interesting ideas. In this case, we had 2 different retailers announced last week. And we copied in their charts from IVolLive. And the first one was Walmart, which we'll look at today. The second one was Target. And I like going, recapping these editorial pieces because it shows how kind of these names play in to the research tool of IVolLive, and then how they can lead to actual actionable trades that we can put on as options traders. So we kind of come through here, and then we have how to play it. And as I mentioned, I've spent a lot of time recently on on charts and the real-time spread scanner. So we put and included all of those links here at the end of this piece. So going back to our dashboard here, that's kind of a broad overview of what to look for when you first log in any given day. That's kind of my coffee in hand routine, if you will. And then we come to IVolLive. So this is the first place I tend to use calculators in any given trading day. So you can see from left to right, let me get this band out of my way. So we have from left to right, some of the tabs that I've been looking at. You can see this is my stock monitor tab. We're not really going to spend a lot of time on this. The stock monitor tab is where you would run kind of broad-based scans on the market. You could look for, top stocks by volume. You could look to see where implied volatility was much higher than the historical volatility. So this is like future versus past. You could look at implied volatility historical ranges, like a 52-week range for a stock. This is a 52-week range for implied volatility. You could look at the implied volatility change day over day. So this is telling us kind of within the Dow, the DJX, where the action is today, which looks like it's Amex, JP Morgan, Nike, United Health, and Intel. So a lot of cool things you could do here. This stock monitor, though, as anybody that's been with us for a while, this deserves a webinar in and of itself. So we'll dedicate one to that in the coming weeks. And what we'll do is we'll just go through, we'll run all these scans, we'll create custom scans as well here, where we'll come through and we'll figure out what criteria we want to look for. And then we'll create custom groups. To show you how to do that, though, I know that's a question that comes up often. I'll just show real quick how to do a custom group, and I'll have pre-planned examples for today. So what I'll do is I'll say A2223 calculator webinar. If I could spell it correctly, that'd be helpful. And hit save. And the examples, so that's an example of how to create a new group. It starts off as blank. I'm going to key in the ones that I want to show you guys today. VIX. So I have TLT, VIX, Apple, and also have Walmart, Target. Walmart and Target were in that editorial piece, and Keurig, Dr. Pepper. So there we go. You can see we just created a new list. This is what I did kind of in my research leading up to the webinar, which is kind of what I do any given week. But you could also simply, select symbols to add to this new group. You could also upload from a CSV file into this new group. So all sorts of things that you can do. But we just created our group for today's session. On charting, I showed kind of the reason why I almost have these tabs in left to right in kind of the order that I use them. Charts, if we're doing a charts webinar, these would be over here on the left. As you can see, you can just toggle these. That's how you move them left to right. So nice little IVolLive hack there. And what I like to do when I come to the VIX is I like to, what I showed in charts, I like to see what's going on. I like to look to see the VIX is kind of this inverse indicator for the market. So, the higher the VIX, so spot price is here in blue. So if we look at the higher the VIX, right, the lower that the market tends to be. The lower the VIX, vice versa, the higher the market tends to be. We could scroll out to 5 years worth of data, and we can look to see with this blue spot price line where we've had these spikes. This was March 2020, so this was during COVID. So we could see we had this big spike in the VIX, right? And so I could come here, circle that. And then we had this, the VIX obviously came back down as COVID kind of receded. And then we've been in this kind of long spot price downtrend for the VIX, right? It's really been subdued despite, kind of rising interest rates and whatnot, causing the occasional gyration. You could see we've been more or less, here's a little arrow, and then we can bulk up this line. So again, in charts, I showed how to, create these charts, how to mark up these charts, how to add technical indicators. But the reason why I want to show kind of how a chart plays in with a calculator for the VIX is because the VIX, again, can be a leading indicator on where the market's going to go. So if we come here, get rid of that. And then what we can do is we could also eliminate spot price, and historical volatility. So now we see this is just a pure VIX of the VIX, right? This is the implied volatility of the VIX. So this is the fear gauge of the fear gauge, which is, again, another thing that I pointed out in the webinar series. So what we also did is we added our technical indicators on top of the VIX. We added Bollinger Bands and RSI, two simple ones to understand. Basically, we were looking for extremes. And so when I'm looking to put on trades, I want to know, well, where's the VIX? Is it high? Is it low? Is it an extreme? Is it above its Bollinger Band, below its lower Bollinger Band? Is it extended above 70 on the RSI? Is it below 30? And I like to look at this two ways: visually on the chart, and then through the probability calculators, which we'll pull up. Because right now on this chart, this isn't really telling me much. I mean, we're coiling here. So there's going to be a move, and it's going to be either higher or lower because it's building up energy as these Bollinger Bands kind of coalesce and come together. And as these peaks to troughs get tighter and tighter, something's going to happen. It's going to either break higher or lower with a VIX. But with a chart like this is looking at what's happened in the past, right? So we need to know what's going to happen in the future. So what I like to do is I like to come here. You can pull up calculators a couple different ways. You could pull them up here, from this aptly named calculator tab, right? Or you can pull it up on each individual strike price. So if you just wanted to look at something in general, and you were on IVolLive, you could just pull up this calculator. You could type in the symbol here, and then you could choose VIX, and then you could choose the different strikes and everything else, and you could do that manually. Or what you can do is you can go to the specific strike price here in expiration. So, this expires on the 23rd, right? This expires on the 30th. This option expires on the 6th of September. This is the 13th. And this is the 20th. So let's say you wanted to see where the VIX was going to be 1 month from today. So today is August 22nd. September 20th would be about a month from today. We can see that the current price is 17.43. And so our at the money option is 17. So then what we could do is, if we wanted all of this to be preset, so all of this to be within, our data set here, we would just pull up the calculator button, and you have two calculators available to you. One is the options calculator. This allows you to play kind of your own market maker, because what you're really able to change here is the time to expiration, and the implied volatility. And when you do those two things, you can see the update in real time of what the options price will be. The other calculator, which we'll do, the other calculator is the probability calculator. This is probably my favorite calculator because it shows us the likelihood of an underlying stock or instrument, in this case the VIX, hitting two different price levels. So what I like to do is I like to use the lower price as price 1. So in this case, we'll say, okay, what's the likelihood that on September 20th, 2023, the VIX will be below 17? And then on that same token, what's the likelihood that the VIX will be above 18? And you can see the parameter we're using is at the money volatility, right? Because we're using the at the money strike price. The other things we could screen for are IVX 30, which would be a little bit higher at 82. We could also look further out. We could also screen against what's happened in the past with historical volatility. But kind of the most common and the one I use the most is this ATM, at the money volatility. And what we can see is when we hit confirm, the likelihood that the VIX will be below 17 on September 20th is 48%. The likelihood that it will be above 18 is 42%. The likelihood that it'll be in between these two prices is only 10%. So, that proves out what we just saw in the chart, where a move is building and the market doesn't know if it's going to go higher or if it's going to go lower. The market just knows it's going to go somewhere. It's not going to stay stagnant. The way this is applicable for real money trades is I can now design a straddle or a strangle. I could say, okay, I could use 1750 or 17 as my in-between price. And then I could put on a straddle trade or a strangle trade that says, look, we don't know if the VIX is going to go higher or lower, but what we do know is it's not going to stay stagnant between now and September 20th. And that's where our real-time spread scanner comes in. because I'm able to create these hypothetical spread trades within the real-time spread scanner, knowing this information from the probability calculator, that I paired with the charts. So that's kind of like the advanced use case of a probability calculator. Like I instantly know when I see these percentages that I should be looking to do a straddle or a strangle. Whereas if this was below price, 48, below price 80%, for an example, I would know to put on a bearish trade. And if above price, on the other hand, inversely, if the percentage to be above price 18, let's say that was 80%, I would know to put on a bullish trade, right? Because this thing's going higher. So those are kind of the real world applications of the probability calculator for the VIX. Other things that I love doing here, the VIX is European style. Most of what we'll look at today is American style, but the VIX is a European instrument, which means you can only exercise it at expiration. So you'll see kind of less of an impact sometimes on the Greeks. But, the things you're able to do is you say, okay, well, what would happen to these prices over here, for the call and for the put, if we were only 10 days out from expiration? That's days, hours, minutes. And what if implied volatility went from 79 to 100? What happens then? And you could see the pricing will update, right? So we'll see, I'll change this so we can see in this view, the strike price will do 18, right? And we'll make all those moves. And so we could see for the call, the current pricing on that call, that $18 strike is $1.81 on the bid. And we could see, even though volatility went up, from 79 to 100, right? So more than 20 absolute percentage points. The fact that, we have only 10 days left to expiration means that call option still is cheaper now than it is today. That shows the power of time decay. Ultimately options are decaying assets. So the power of time decay really kicks in those last 2 weeks leading up to expiration. So had we bought this call, we'd be underwater on it, $1.80 down to 99 cents. Had we sold the call, we'd be, earning money. We'd be profitable on paper because we'd make the spread between $1.80 and 99 cents. So we'd be up about, 85 cents on that call had we sold it. On the put, we'd be, if we bought it, if we bought it today for $1.62, we'd be down a bit under this scenario, right? So implied volatility going up, time going down, but price staying the same, right? Now, on the other hand, if price changed, right, the put is all of a sudden a lot more valuable if we bought the put, right? Because now we went from the current price, 17.49, down to 15. So even though we bought it today for $1.60, it'd be worth, 3.16. Right? So we'd be above water on the put. And obviously the call would be deteriorating rapidly down to 19 cents because we have the share price going down. So what's so cool about this is you're able to play market maker with whichever option you like best. You could change the price of the underlying. Again, that's the VIX. You can change the strike price to whatever you like. You could change the expiration date. You can change the time to expiration. You can change the implied volatility. You can even change interest rates and dividend yields if you so desire. So in that case, you'd be market maker, Fed chairman, and chairman of the board. So a lot of really cool things you could do here. But the key takeaway is I like to use this to measure kind of the at the money and then one strike price above, so 17 and 18. And then I like to design a trade around that. And in this case, I would design a straddle or a strangle, which I'll include in our recap video when we send this out, how to design those trades. I'll include that recording, but that basically tells me within 5-10 minutes, I have a very interesting potential trade here on the VIX. So moving along to the second example that I think is powerful, TLT. So TLT is one of the most widely followed ETFs in the market, and the reason is it follows the iShares 20-year plus Treasury bond ETF. That's what it stands for. iShares 20+ year Treasury bond ETF. It's a mouthful, but what it basically means is, let's pull up the chart. When traders are worried that interest rates are going to go up, then the price of TLT goes down, and the price is in blue. Right? So here's blue. So look at that. I mean, traders have been extremely worried about interest rates going higher, which is why, the price of TLT has just absolutely cratered. So here I would have drawn an arrow showing what's going on with our handy Picasso tools here. So we have this clear downtrend, and while price has been going down, look what's been happening to volatility. Historical volatility is in orange, which is spiking, and implied volatility is in green, which is spiking. So we have this big divergence going on right now in TLT. So the question to me as a trader becomes, okay, is this downtrend going to continue, which means interest rates will continue higher, or is this downtrend going to reverse, which means interest rates will either stabilize or go lower? So that's kind of, the mental math that I'm doing when I see a chart like this. And then what I'll do is I'll come over here to our handy calculators and I'll say, all right, interest rates are hard to predict in the short term. So I like to go more intermediate to long term. And we could say something like, let's scroll down to the December expiration for TLT. All right, December 29th, that's the last expiration for this calendar year of 2023. The price right now is 93. So if we pull up this our handy calculator here, and we go to the probability calculator and we say, all right, the current at the money strike is right at 93. And then one strike above that would be 94. And we hit confirm. We see that the probability of TLT being below 93 is 45%, but the probability of it being above 91 is 51%. So basically what this translates to is the computer is saying it's more likely than not TLT will be higher than 94 at the end of at 12/29/2023. So at the end of this year. So to me, what that says is, interest rates will at least stabilize, if not go higher, because otherwise the likelihood of TLT rising would be zero. There would be close to zero, So the fact that TLT could rebound here and at least stabilize tells me that we might be at the end of at least a sharp rise in interest rates. And this is very, very valuable, information, because even if I don't trade TLT specifically, even though this again is a great spread trade opportunity, because what we're saying is it's either going to go below this or above this, but it's not going to stay, stagnant. So just like the VIX, this would be another potential spread or strangle trade. But again, it tells us, hey, look, if this was, below 93, let's say if this was 80% chance, then we'd be bearish on TLT. And if we're bearish on TLT, that means interest rates are going to rise higher, which could put pressure on the market. And if interest rates higher, Wall Street freaks out, equities go lower. So this is how it all kind of plays together. Options calculator, again, we could come here and we could play market maker. We could do things like, what happens if we're instead of 129 days out, what happens if we're 30 days out, and what happens if implied volatility goes nuts going into November, December. So we go from 17 to 50, for an example. And then interest rates go higher. So they go to 5.8%, right? And then the dividend stays the same. And then we could see this is what happens to the prices. So even though we're only 30 days out on the expiration instead of 130 days out, this call price goes to $5.60. The current call price is $4.30. So if we bought that call, we'd be making money. The put price goes to 5.18. So if we bought that put, we'd also be making money. And the reason why we're making money on both the call and the put leg of the trade would be because implied volatility went up so much, right? And that's why these spread trades can be so powerful, because again, even if the price goes nowhere but volatility goes higher, we could be profitable on either leg of the trade. So though that is TLT, I like to use TLT to tell me where interest rates are going. And then that in recent trading, maybe 5-7 years ago wasn't a big deal because rates were just so low and it was boring and nobody cared. But now interest rates tend to really move the market. And so that's why TLT is right next to the VIX for me. I analyze the VIX every day, then I analyze TLT every day. And then I go into like specific trades that I could be interested in. So Apple, we used last Tuesday for charting. And what we pointed out was, Apple is going to be, let's look at this. So Apple is going to be announcing earnings October 25th. So, right now what we've had with Apple is its share price has gone down. It had a very strong start to the year, right? So tech in general had been very strong going into the year, 2023. So let's draw our handy line here, bulk her up a little bit, and there we go. So we had this nice, clean, beautiful uptrend. But what was interesting is look at this green line, implied volatility. Implied volatility was kind of hand in hand with Apple as it rose, and this was kind of a leading indicator that the trend could change, right? Why, this with a gentle uptrend like this, implied volatility should be decreasing. So when it wasn't decreasing, this was our signal that something was going to happen and Apple would likely turn lower, which is exactly what happened. Because check this out, after here, right, in early August, we've had this, after earnings, we've had a steep downtrend, right? And implied volatility's come down some, but it's still relatively elevated, right? So that means the market is still unclear on the direction, right? Apple could go higher or it could go lower, but this is the current setup we have. So this is what's happened in the past. And now what we want to look at is what could happen in the future. So we can minimize our handy chart view, and we could go to the expiration after the next earnings release. So Apple's announcing earnings on October 25th. So let's go to, this would be too soon. So let's go to the expiration after, which is November 17th. So right now the price of Apple is 176. So the at the money option is here. It's always in bold, 175. We can pull up our handy calculator. Let me go here so we can all see the prices. So the price is beneath. I like to have my calculator here and then my strike price in my frame below it. So then I go to probability calculator, and basically what I'm saying is, okay, should I go bearish or bullish on Apple, like looking at and through its next earning release? So I like to use the at the money as price 1, and then one strike higher as price 2. Let's see what that is. That's actually 180, 80, right? Because it's in $5 increments here. So all else being equal, the system is predicting that there's a 45% chance we'll be below 175 at expiration on November 17th. And there's a 46% chance we'll be above price 2. But this is kind of another hack that I want to show for the probability calculator. Here my instinct is sell to open a put option at 175, right? And capture the $6.40, because there's less than a 50% chance I'll get put. And even if I do get put, I love the idea of owning Apple at the current price. So my real cost basis would be 175 minus 640. So I'd really be buying Apple at like, $1.68, $1.69, which is fantastic in my book. But the reason why I go to that so quickly is A, I've traded Apple tons of times in the past, but B, even though there might be a 46% chance that Apple would be above 180, A, that's not really great. You want to see 50% or more before you go bullish. But B, look how expensive that strike price is. 180, we go to the calls, which is always on the left-hand side. C here stands for call. And to buy that, we'd have to spend $7.50 out of pocket to buy it. So really what we need to know is not the likelihood Apple will be above 180. We need to know the likelihood that Apple will be above 180 plus what it will cost to buy the call, which is say $7. So let's go 188. So you can see if we bought this call option, which a lot of traders, they get excited and they just kind of wildly buy call options without thinking of the implications of the price they're paying. What this is saying is, okay, really to break even, you need Apple to hit $1.88 by expiration, November 17th. And there's only a 32% chance that will happen. And that's why so many traders lose so much money when they blindly buy calls and puts, because they're not playing the odds. The odds to play here are, hey, sell to open this put option at $1.75, get paid the $6.40, and there's less than a 50% chance you'll get put. If you do get put, you're really only going to get put at about $1.68, share on or around that. So again, this is how within 5 or 10 minutes I kind of have an actionable trade that I can make. I'll show how to analyze that in the P&L calc before we wrap up today, but I just really wanted to, kind of go through some of these examples using our calculator. Now I'd like to move on to Walmart. So Walmart and Target we covered in our editorial piece within our dashboard. If you joined us late, we went through kind of different trade scenarios for Walmart. So what's interesting about Walmart now, let's see, if we pull this up, Walmart announced earnings that were strong, but yet the market reacted relatively negative, not, markedly so, but negative enough to send shares lower, but also implied volatility lower, right? Which is our green line here. So what's interesting about this is options are getting less expensive, right? Because we have implied volatility going down. So if you want to make a trade on Walmart, now could be a good time because options are getting cheaper. Look at that. Here was our implied volatility price leading up to earnings, and now implied volatility is going lower. So the trade that I was looking at was, all right, this chart's turned lower here, price, which is blue. Will it rebound or will it continue lower? Should I do a bullish bet or should I do a bearish bet? So, typically aftershocks from earnings can take up to, 30, 60 days to play out. So let's use September 15th as our marker. That's about 45 days after, the earnings release. So if we go to this at the money,
Hi, Marion.
we go to this at the money strike price here, and we go to our probability calculator, we could say, okay, what's the likelihood on September 15th, Walmart's going to be below the current price, more or less 157.50. And then we could go to the next strike price, 160, confirm. So here we go. There is a 53% chance that Walmart will be below 157.50. There's only a 31% chance it'll be above 160. So what this is leading me to believe is, it makes sense to at least explore a bearish bet. So now I could say, all right, what if I just bought this put? Really I need Walmart to drop 157 and I need it to drop an additional 225, right? Because it's going to cost me, I need to drop an additional 255. Let's go to the puts over here on the right to put on that trade, right? So more or less we need it at 155, let's say. So what's the likelihood that Walmart will be below 155? And we could see there's only a 37% chance, right? So it wouldn't make sense for me to buy this particular option because it's so unlikely that once you account for the cost that'll take me to go bearish, I would be profitable. So here I would also probably put on a spread trade. Like I might sell the one, let's see, 162 call, or maybe the 160 call, use that income to then, so if I made $1.13 and then I spent 259, I could cut my cost in half, right? To buy this put. So all of a sudden, instead of 155, I only need Walmart to be below 165.50, and here there's a 46% chance. So I just improved my odds of being profitable on trade dramatically by kind of doing that mental spread trade there. And again, that comes with time, that comes with experience, and it comes with time. And we can run all those scenarios through our real-time spread scanner. But when I run these and I look at these probability calculators, those are some of the things that jump out to me right away. So now let's go to Target. So Walmart, had solid earnings. Target's the market absolutely hated. And how do you know that? Well, let's go to this chart. Let's pull up 3 months. And you could see here is where here's where Target announced earnings here. All was good until that went live. And then afterwards, this stock price has been, got thrashed. But there has since been a rebound, right? So again, it takes, sometimes 45 to 60 days for these trends to really play out. The aftershocks of an earnings release. So now we have this rebound, and you can see what also happened is spot price came up and it kissed our implied volatility level, right? So we had a kiss right here, and then spot price has continued lower. So now the question is, will it stabilize, right? In which case we can maybe sell to open a put or buy a call to go higher, or will it continue lower? In which case we should put on a bearish bet. So again, we head on over to our handy probability calculators, and we play market maker. We come here, September 15th, which was the same as what we looked at Walmart. And we looked at the 124 strike. That's right here. That's right at the money. So we pull up our calculator, and then we say, all right, so looking out to September 15th, we come here to probability. Then what's the likelihood will be below the current price, 124? What's the likelihood will be above the next strike price, which in this case is 125? So it's a 50% chance will be below 124. It's a 45% chance will be above 125. It's only a 5% chance that will be between price one and price two. So target's going to move one way or another. It's going to move higher, going to move lower. The market, is favoring a downward move more than an upside move, but it's still pretty close. So just like TLT and the VIX, this tells me that target is very, very tradable from a spread standpoint, because, again, it's going to go low or it's going to go high, but it's not going to stay the same. We can come over here on our options calculator. Again, we could play market maker. We could say, okay, there's 24 days left. What happens when we go 5 days left? And what happens if implied volatility goes from 27 down to 17, because it gets, less volatile as we go further out. And we could see here the call option at 124 today cost, say 360, the difference between the bid and the ask. That would go down to $1 essentially. So if you bought that call, you'd be underwater. If you sold that call, you'd be profitable on paper. The put today costs $3.20. It would have decreased to $1. So had you sold that put, you'd be profitable. Had you bought that put, you'd be unprofitable. So again, this is playing market maker. We're saying, all right, what happens when things change? Now, if target did break lower, right, you could have, here, 120, you can see that call option goes all the way down to 8 cents. It's worth basically nothing because we're 5 days out and we're down to 120. And that put has become profitable, right? From $3.20 to $4, even though implied volatility went lower. And then we could see if we pull that back up and we go to options calculator, we leave everything the same, but we change this last price and we say, okay, what happens if target breaks higher, to the upside? What if it goes to 130? Well, here, this call option would double in value, right? So if you bought the call, you'd be doing great. If you sold that call, predicting that target's not going above 124, you'd be underwater about 50%, right? Because what you sold for 365 is now costing 750. On the put side of the equation, you'd obviously be underwater if you sold it, right? Because target's now 130, and if you bought this, if you bought the put for 320. You're underwater because now we're up to 130. However, if you sold the put, you'd be profitable on paper, right? Because you sold it for 320 and now it's worth $1.18. So that's how buying, selling options can work. And this is only with the last price changing. This is nothing, with timed expiration or IV. Of course, we could change those inputs as well. We could say, well, what if we're 10 days out? And what if implied volatility, skyrocketed because we're going into November? And we have the holiday shopping season, and let's say things get volatile with interest rates or the consumer. This is what happened. The call option is still very profitable, right? Here, 365 is now worth 814 if you bought it. And then the put, if you sold the put, you're still up, right? Because you sold for 320 and it's only worth, say, $2. So you're still up. If you bought the put, however, you would be underwater because even though implied volatility is higher, overall, the underlying spot price is a larger determinant. And so since it's going higher from 123 to 130, you would be underwater. So those are the calculators. Again, you can access them. Look at that. Any strike you're interested in has a calculator tailored to that strike price, which is incredibly powerful. The other main calculator within iVolatility is the P&L calculator. So we do a webinar solely dedicated to P&L. So that way, we can give this tool the justice it deserves. But just to show, since today is dedicated to calculators after all, if we used Apple and we went to that November strike, right? Because that was after the earnings release. We had the November, what do we have? The November 175 is what we were looking at. So here we are. What I like about this is, how in that prior screen with those calculators, I was mentally doing the cost basis, like what it would cost to buy the option or what it would cost to sell the option. What I like about this is that the P&L calculator accounts for the cost. So here we see the cost here is $6.60, and I'm buying to open this 175 put on Apple. So it accounts for my cost. That's what this blue line is. This blue line is saying, look, it's not as easy as saying, hey, we need this thing to go below 175. It's we need to go even lower than 175 to start making money, right? And that's what I love about the P&L calc. It automatically does all that math for me. Don't get me wrong. I like the mental exercise of doing it on the probability calculator. It keeps me sharp. But here, it automatically accounts for it. And then if we sell the put, right, our P&L changes. Now we're profitable because we're selling to open this put. We're profitable as Apple goes higher, and we're unprofitable as it goes lower. And I could see that in chart form, and I could see that here in table form. Other thing you could do here, similar to the probability calculators, is you could play around with a volatility change. So that's a 10% absolute change that went from 24 to 34, and that shows you your updated pricing for this option. You can play around with days to expiration. So we could say, all right, well, what if we went from 87 down to 25 days? So you can play with it there, you can play with it here, and you can also toggle it. So we're big fans of being able to play with days to expiration. We call that DTE. You could also play with pricing. You could also say, well, what happens if I get a better price than 655? Since I'm selling to open this, what if I get $7 and everything will change? And then in advanced settings, you can play around with interest rates. You can play around with dividends. And what those will, when you do that and you hit apply, it'll show you the impact on the underlying option price. So if the dividend amount went from 24 cents to 50 cents quarterly, A, all Apple shareholders would be extremely happy. And B, this is what would happen to this specific option price, the Apple 175 strike, if those dividends were increased. And then these Greeks, they automatically update depending on what we do with the inputs here on the screen. So that's the other calculator. Again, we do a whole webinar dedicated to P&L calc. I can include that in the recap email we'll send out to everybody. So that way, at least you have access to it. But primarily what I wanted to focus on was showing real world applications for some of my favorite tickers that I look at any given day. I look at VIX and TLT every day. Apple's like a bellwether. I look at that. I've been digging into this relationship between tech and energy, which is why I have ExxonMobil up. And then I also did a deep dive on the retailers after their earnings with Walmart and Target. And then on my notes, I have, a further analysis of, Keurig Dr. Pepper that showed up as I was doing some pre-market research. So like I'll go here, and what I noticed was these three lines coiling. So we have spot price, implied volatility, and historical volatility coiling. So what this means is I would circle here, and this is a 1-year chart. So this takes time to build, but this means some kind of breakout is going to happen, right? So then I'd come here and I'd say, well, how much time do I want to buy for this breakout to develop? And I could come out, maybe same thing, maybe here to November, and I could look at our probability calculator, and I could say, all right, I know some kind of move is going to happen with Keurig Dr. Pepper. I'm giving it to November for that to happen. And I could say current price is around 35 for our at the money strike for November, because it's a bit out there in time. It's a little bit higher than the current share price, but it's 35 regardless. And then our next one is 37. I could hit confirm, and I could see that there's a 67% chance that will be below 35, by this expiration date. And there's only a 14% chance will be above 37. So what this is telling me is this coalescing happening here is more than likely going to break out to the downside sometime between now and this expiration date. So that's very valuable because I can now use that to design a bearish trade on Keurig Dr. Pepper, right? So this is how they all kind of play together. I saw this chart formation. I went to the probability calculator. Then I'll run a bearish trade. I'll design a bearish trade here in the real-time spread scanner. I'll run it through the P&L calc. And then if I like it, I'll execute it with my broker. So that's kind of how it all goes full circle. So I hope everybody enjoyed that. We're about 45 minutes after the hour. I want to pause now for any questions. I also want to post, we always appreciate any feedback on these sessions because we always want to make sure everybody's getting a lot from them. So support at IVolLive.com. Me and my team always appreciate any kind of feedback. We enjoy putting these on, so we want to make sure everybody's getting the most from them. And then also, if you're not currently here is our iVolatility Data Cloud API, something that we've spent a ton of time on over the past year. It's really, really powerful for back testing and whatnot. And then again, here we are back to our dashboard. And then if you're not currently a user for IVolLive, that's fine. We offer 7-day free trials. And so for an example, if I logged out here, it would take us to our general screen where you could here we go, IVolLive. And here we are. Sorry, it's logging me out now. This is our iVolatility options. We do have options and futures. So this platform you just saw works for IVolLive options and IVolLive futures. API is something separate. So if we go IVolLive options, this is where we have our different account types. What you saw me use today was the Pro real time. So everything was updating in real time. Has the stock monitor, options chain, IVX, everything, all the calculators. Advanced also has all the calculators you saw today. The only thing it doesn't have is the real-time spread scanner. And then basic also has most of the calculators, but it doesn't have the P&L calc. So you could just kind of choose whichever you like best. I'll put that here. I'll also put this in the recap email. And then if you're not currently with us, you can, set up, of course, 1 week free, play around with it, and then rock and roll from there. And here's the futures one for our friends that trade futures. So I'll pause for a moment for questions. If there are none, then hopefully that means it was a thorough presentation. Calculators are one of my favorite topics. I use them all the time. So if there's a question, if you want to throw it in the chat, I'll cover it. If not, then I hope everybody enjoyed. Great. Well, thank you for joining, everybody. This has been Jonathan with IVolLive. Again, this recap will be in your inbox. And in the meantime, have a great rest of your day and happy trading. Thank you. Thank you for the kind words, Michael. Appreciate it.